into August. Most importantly, and this is key to the whole thing, there was this arch formation that made a left side, right side price time match, and it just pierced the 1343 low on, that was on Friday, I believe. Yeah, on Friday. And what happened was it went to that low and it sprang back. And that's what happens very often in an arch formation. That's what I was discussing on Friday and Monday. This particular pattern is a potent pattern if you can identify what's going on early and be prepared for it. And there's an inside wedge support line that was hit. So the rally that occurred was actually greater than I anticipated in size for that day, that is, for yesterday. But it wasn't what we, it was not an unusual phenomenon. And that's number one. Number two is, you remember we were talking about Apple, I had calls about Apple, and I said, okay, let's look at Apple. And I said, Apple, and I drew in the arch formation. I said, Apple could rally 50, 60 points. That would be natural move to the upside in the arch formation on the bounce. Well, it certainly had a fantastic day. So, here at TFNM, we're all about education. We're all about trying to give you the sorts of technical chart and tools and the veracity of those particular techniques right here so that you can test them out yourself. And of course, you can see exactly what I was talking about when I said the other day that there was a signal based on my on-balance volume. I don't usually use volume per se. I can't say I don't use it, but it's just one of the dozens of tools that I have. And it's really important in your trading and identification. I was talking to someone the other day. We were driving along after playing tennis, and we went past an auto dealership, and I said, isn't it funny? If you hear a rumor at a party and someone says, buy the popular stock of the day, whatever it is, Home Depot, whatever, and you think, geez, I never thought about it. I think I'll buy it. So you plonk down some money, but you actually plonk down a great deal of money. Would you go to an auto dealer or just be driving by and suddenly say, let's see, someone said something about the Audi or whatever it is. I think I'll just go, I'll go buy me an Audi. So you really want technical tools. You want to be building up some kind of confidence. And if you're wrong, you want to know that very quickly you're wrong and you're out. We took like a 1.5% loss in Facebook yesterday. I like Facebook. We have another stock that's done very well in the high-tech area. And what happened was suddenly there was a rumor between these two stocks, and now the one stock that we've been long on had a fabulous move up, and Facebook pulled back. And now, to tell you the truth, I don't know if I'm that interested in Facebook anymore. The more I'm looking at it, it wasn't a peak D in the 120-minute chart. It was not the greatest. The reason why I think it would have held if there wasn't that story, it would have held the stop that I had, and it would have gone up just enough so I could raise the stop so that we could either have had a break-even trade or a very small, as it is, we took a very small loss. But still, I don't like losses. So, you want to learn those tools. And it was the 120-minute chart was let me just look at it right here, Facebook. The 120-minute chart was right there. It was D, and it went to E. And I thought, well, if it went above 24.25, that was that gap up high on the, what day was that? That was on the 24th of October. Then there was a chance, just a chance, that you broke the potential double top by piercing that 24.25, and then you would have got possibly an instant restart, ChapmanWave technique called the instant restart. Well, it turns out it was a perfect D going to an E. And what do you do when you get to a D or an E? Just like you did when you got to the D at 24.25 on the 24th of October. Right there, yesterday at 11:30, it went to 24.12 and then plop, it came down. And now it's trading at 22.97. Oh, it might become a possibility again. The other thing is that in the daily there was this cup formation. This is the double cup formation. And there was a chance that if it broke above 24, it could still do it. But right now I'm just not interested, at least right at this particular point. 24.25, it could then go to 25.44, which is the 200-period moving average, which I believe it's going to go to. I just don't know how deep this pullback is going to be. And it looks to me like it. If the stochastic is at 80% and it holds, then it'll work. If it starts to fail, it won't work. So that's kind of what I'm looking at. Now, going back to my original story, when I was looking at, for today, I promised I'd mention the date. Today is November the 20th. At 30, so the E-minis had that spike, and the unbalanced volume gave a very good signal. That's how I use volume, to say, yep, there could be a bounce. Not only that, my subscribers know that I have certain techniques. A number of them are proprietary in the sense that I developed them, but I talk about them openly. There are a couple that I don't talk about the numbers. I'm just refused to do that. I give away enough information as it is that I spent years developing. So there's something that I think it's mine. And that part of that is the VIX, the numbers on the VIX, and part of that is the numbers on the ChapmanWave Trin gauge. Something that I developed from Richard Arm's Trin indicator, short-term trading index. Well, on Friday, I had a signal to say, on Friday, I had a signal to say that Friday could be a very strong move to the upside intraday. It didn't necessarily say that it could pull back. It just says it's a strong move. Be careful when it finishes that move because it then could pull back sharply. Well, of course, we had a double whammy on the upside yesterday because there were just so many things that were positive. So, huge move to the upside. And then I had a signal based on the ChapmanWave Trin gauge that said, hey, be careful because the opening could see weakness, what I call a rug pull. Not always is it a rug pull, but it would be a surprise decline to the downside. And lo and behold, we had the decline, and it says that after the decline there should be a rally attempt. We've had the rally attempt, and then you've got to be careful. Well, what I did with my opening call subscribers, that's my daily service that goes out every day. Just 6, 7, 8, 9, 10 charts every single day, going through what we have, what I'd like to get, the key indexes. But there's also a chart that I showed today, which I show very rarely, and I'm not even going to tell you what this is. There's this particular chart. And it has trend lines. And then what I do is I go like this. I capture it. I cut out everything from it. And then I go to, I'm going to do this right here in front of you. And then what I do is I go to imaging. This is what I do. Charts take a long time, a really long time. If you do your work diligently and you want to explain it, or you do it diligently and it's for yourself, they're two separate things. Because doing it diligently and explaining it means that you've got to show your techniques. You've got to show what you're looking at. Well, what I do is I take this chart and then I go like this. And that's the chart. I've not touched it. This is exactly the chart that I showed a couple of weeks ago. No, I'm sorry, not a couple of weeks ago. I showed it months ago. Let me check. I'll tell you exactly when I showed it. Well, I should be able to. I've got it written down, but it's just I showed it right there. That was on the 7th of September, back early September. So this is what we were looking at, and I said and I showed it upside down because I think sometimes you get a really good perspective. And I said, based on the ChapmanWave techniques, you had a left side, right side price time match here on the left side, a big arch formation. It was a cup, of course, upside down. And it came pulling back. And then you've made another arch formation, cup formation, obviously in the real terms. And now we're looking at a long and a stretched out cup formation that should make, and this I never changed it, this particular line I had right there. I said that's the line that should make the cup formation, and there should be a return to the left side, right side price time match, and I drew that in. I also drew in once it started, about a month later, I'd say that was probably early October. I said, okay, this is the pattern I'd be looking at, and the gray lines are the lines. Those are channel lines. And I said, that's what I'd anticipate. And there's a chance that we could go up into it, and that was the left side, right side price time. Actually, that was the stretched out one. There should have been one that was sooner, which would have been to that line there. So what you're looking at on my particular charts at this particular point, upside down Dow daily chart, which shows the bullish, i.e. bearish, reversal from the double top. And what it also shows is that resistance, this whole resistance area, which was support yesterday and Friday, is the key level to watch. It says that the channel is still intact. It says that there could be a cup and a handle formation. It says, or before that time is up, there could be a powerful spike, and that spike could take you into a ChapmanWave cup and ladle formation. That'll be down on the, and that would be up on this chart, but down in real terms, because it's an upside down chart. Let me just go to the real one so that I don't keep having to say upside down chart. Right there. And that says, if there is a powerful move, this is the right way around, Dow chart. If there is a powerful move that takes out that resistance line, and that resistance line depends when it is, let's call it 12,960. And I've been saying, based on my work, the 12,900 to 12,990 should be the area of greatest resistance in this particular retracement rally. Will I be correct or not? It's not the issue. It's what you're doing. So what I chose to do is on Friday, I said to subscribers, for those of you who swing trade, now is the time because you've made this left side, right side price time match. Look, this is exactly what I was talking about. Here's the Dow chart and there's that support level that I was talking about. So that was a perfect time to take some of your profits off. On the short side, we had 4 shorts. And look at the Qs, 1, 2, 3. Same thing, left side, right side price time match. Went down to 61.31. A day later than what I identified as a left side, right side price time match. And Apple had a stupendous move from 505 to yesterday's high of 571.95. Now, for me, what was important was there was a round number close on the way down. It was important for me to see that Apple could break that 558 round number, which it certainly did yesterday. Now it's trading at 561, 562, and the low today is 558. Isn't that interesting how these numbers come back? So if you want to learn about these numbers, I've got a webinar coming up, a 2-day webinar, December the 6th and 7th, Thursday and Friday. I'll teach you about these patterns. Look how many times you've seen the PDs in the ChapmanWave. Look how many times you've seen the cup or the arch. I'll be back at 877-927-6648.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Masters Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at tfnn.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi, folks. Basil Chapman. We're back, and we are looking at the HGX index. What is the HGX index, you ask? Well, the HGX index is, in fact, the Philadelphia Exchange Real Estate Index. And right now, it's showing that the high, most recent high of 170.81 in the daily chart was pulled back to 149.28 on the 15th of November, has had a really strong move. I'd say it's about almost about a 50% rally over the 9-period exponential moving average. And this is the thing that I've been wondering about in the real estate sector, just for at least a short term. I have to tell you, a place like Brooklyn, I've spoken about this very often. And I said, how the whole thing fits together is going to be really interesting. Why? Because so many things have been going on in Brooklyn, certain parts of Brooklyn, that is. You know, you've got that beautiful waterfront. Oh, it was a very ugly waterfront with the docks, and not the docks, with the different wharfs and and all those industrial complexes. Well, what they've done is they've started building parks, and it's got a beautiful walkway. It's just fabulous. You go along the river. Along the Roosterfeld, on the other side, the Brooklyn side, and you are, it's just beautiful. On the ferry, you can go across to Manhattan by ferry. But what's really interesting is that the building slump that occurred in 2000 and about 8 and 9, going into 10, saw the condos convert to apartments. So I discussed this many times. Now there is such a boom going on that rentals have gone from I'd say maybe a 2-bedroom near just different parts of Brooklyn. You could get 2,200, maybe 23, maybe 25, maybe 28, depends on what you want in a month. Now the prices are skyrocketing, the rentals. That's number one. Number two is there isn't that much room, so they've had to take down or repair or refurbish many apartments. So there's an absolute boom going on. Now, we know that booms invariably turn into a bust, but this one has been boiling. It's been on the back burner because the prices never really came down that far. Remember, I've been saying, what's with this? How come in the Northeast prices have held so well since the 2005 market top, going back to the HGX? Remember, HGX made a top. Oh man, I don't know. This is a 120-minute chart. There it is. Made a major top back at 293.66 the month of July 2005. Came down to 54. I mean, that is a smash. Now it's up at 161, so it's a threefold increase. In leg D, in the monthly chart, the MACD is still strong, stochastic still strong. So I've spent a lot of time trying to put this whole puzzle together. I think I'm getting this for my own interpretation. Of course, I'm not an economist. I have to just do it in my own way. And I think I'm coming to some kind of, I've extrapolated all the data that I've got sitting inside, inside one's head. You always have this data. I'm putting it together, and I'm saying to myself, the balance between the absolute catastrophe of housing in the southern part of the United States, mid and southern part of the United States, and the Northeast, not the mid, maybe, I'm not so sure about the mid northern parts of the country, but certainly I hear about the West Coast on the north side, and up here on the East Coast, prices held really well in many areas. There were defaults. I mean, it was not pleasant, but prices actually held very well. Now they're coming back pretty strongly, and I'm wondering if this isn't the coda, that this isn't the part of the real estate, that whiplash. You know how you, oops, sorry, I'm falling my hand around. I always think of that game, I don't know what the name is, but kids are running and they're holding hands, and then one person stops, usually it's an adult that stops, and then everyone trails along. So I'm wondering if we aren't looking at something here that says this is the remnants of the storm, the coda part of it. And yes, the prices have held well, and certain areas are even going to see a boom. My thinking is going out further, and I'll extrapolate from that data, and I'll talk a little bit about it when we get back. Basil Chapman, Dow is now down 13, S&P is unch, and fascinating after such a powerful day yesterday. But we were looking at the trend gauge. Trend gauge said down before a rally, and that's kind of what we've got. I'll be right back. I'd love to take your calls at 877-927-6648. We'll be back with John in Philly straight after this. We'll talk about the Dow.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, folks. Basil Chapman, Tiger Technicians Hour. Let's see. The Dow is down 12. Let me just run a couple of numbers. We're going straight to John. So we've got the Dow down Dow's down 12, S&P's up 21 cents. Comp index is, if I can find it, comp index is right now. Oh, there it is. So we're all set. Here we go. The comp index is down 129.14. Gold is down 3.5 at 17.31. Silver's down 11 cents. High-grade copper's up 55 cents. That's good. Crude oil is down $1.77, and bonds are down 23.30 seconds. We're going straight to John in Philly. Hi, John. How are you?
Good morning, Basil. Good to speak to you.
Good to speak with you.
So I wanted to pose two things on the Dow Jones Industrials.
All right.
First, could I ask you a direct yes or no question and then share an observation with you?
Yes. That was it.
On the question.
I thought I just answered it. I said yes.
You did. You did indeed. On the Dow.
Yes.
The high on October 5th.
Yes.
13,661.
Correct.
If you had to speculate, do you believe the Dow has topped and it will, after this bounce, make another leg lower? Or will it go back and retest, if not exceed those highs? That's the question.
Okay. Today's Tuesday, so here's my answer to you. I'm going to say yes, the Dow has a chance to get to the 13,661. Now I have to also add to that, as long as the volatility index remains in the mid-teens, it's going to give buying pressure. And as long as bonds, which have made a peak, I'll go to the TLT, made a peak D in the weekly chart, has rallied quite nicely here. If the weekly stochastic cannot get, it's at 62%, if it cannot get up into the 80% to sustain a move, and that move would have to take it above 127.19. So remember, I like to talk about my three bears, VIXI, Dolly, and Bondi. So I have to put these three things together. So the dollar's had a very nice move up, it has to sustain that move. So far, it's actually holding pretty darn well. If it cracks 80, it's at 80.96. If it closes under 80, then the 79.88 will be really important 200-period moving average support. If I know you wanted a yes or no answer, but you know that I'm a technician. So I have to give you the parameters that I'd be looking at. I must also tell you that looking at the chart formations of my four Dow horsemen, GE, IBM, Triple M, and UTX, at this particular point, I have to say that it seems to me that the rally probably, if you ask me just my opinion, would probably fail underneath 13,661 for the Dow. It will probably not break 12,990s. That's my opinion right now. But if that volatility index holds low, I don't know if I would want to fight it, because it was saying that money is coming in and that money is buying pressure. Now, people talk about fear and greed. I just, I cannot use those terms for the volatility index. It's buying pressure, selling pressure. I try to keep it as simple and as unemotional as possible, because you start to use terms fear and greed. Besides which, when people talk about greed, for instance, I've been short 4 stocks. They did beautifully on the downside. I said, I'm going to lower the buy stop so that we definitely do not take a loss, because at least 2 out of the 4 look as if their weekly charts are so poor that they can continue lower. Well, if I'm correct, it saves me the hassle of trying to re-enter the position. Is that greed? No. To me, that's money management that I'm trying to do. We know that I said on Friday, take profits if you want. But there's also the aspect that, yep, we could get taken out with a much smaller gain. But there's also this aspect that if the market starts to fail, the stocks, at least 2 out of the 4, maybe even 3 out of the 4, are vulnerable to the downside. Now, that says to me, you've got to use that kind of rationale when looking at the chart. So if I'm looking at the TLT, and I know you look at it very closely, the TLT, the stochastic has not turned positive yet, although the price went a little higher than it was just recently. So far, it's holding very well. If money comes out of the market back into bonds, then you will see bonds start to climb and you will see the market pull back. They don't always work together, but lately, often enough, they have. So I want to put that whole mix into the pie, and especially with Thanksgiving coming up, and I want to get something that says I can see the meal, and the meal says very simply, and I think this is really the question that you have can be answered quite quickly. And let me just get the white chart up here. Very quickly, if I do this, if I show the Dow chart on a daily basis, it's a pattern that I call the V-shaped formation. There's a pattern I call the cup formation. The V-shaped formation is a pattern that we had seen a number of times. The last low that made this was on the 4th of June. There was an ugly candle down, a doji candle, another doji candle, just like we saw on Thursday, Friday, and then a powerful move up. And then the third day of the rally, which today is the third day, there was a candle that the diamonds and the Dow are a little different. The diamonds had a doji candle. This one here is kind of like a doji, but it wasn't fully a doji on the Dow. Now, we've matched so far that. And the stochastic has turned up. It's not yet over 20%, and the MACD has turned up, but it has not yet crossed positively. I can tell you this, that if the MACD starts to cross positively and the stochastic punches into the 28 to 32% area by Friday or Monday of next week, then 12,903 will be the 200-period exponential moving average that should break to the upside. And if it does, it'll suddenly become support. If the Dow fails in the 12,980s to 12,950s and makes that, the U-turn, that arch formation, then I'm looking at it and saying, I don't know if it's going to have the power to do that. Now, here's the other thing. In time, I know you look at time as well. In time, it would say that if there is going to be a V-shaped recovery, then the Dow needs of course, the other indexes as well, but I'm saying that I'm using the Dow right now because mostly where the Dow goes, the others will follow. If the Dow is able to get into that very ugly bar of the 7th of November, and within I'm going to say within the end of the first week of December, if it's able to take out 13,228, that would be very, very positive. So actually, I'm going to modify that answer. The answer should be, in the time frames that we're looking at, if your question is by the end of the year, will the Dow be making its way towards the 13,000s to be able to test those highs, the 13,600s? Then my answer says, only if this rally makes a V-shaped recovery and you just constantly make higher highs almost every single day into the first week of December. If it starts to fail and comes back down, that's going to be very difficult to do. I think that's the answer I'm most satisfied with.
Well, I thank you for that, Basil. And if you've got time, I have a observation you might be interested in that I'd like to share.
You've got an observation?
Yes, if you have time, I have a 1-minute observation to share with you.
Okay, let me just, as you're about to do that, because we have Ben waiting from Tallahassee. I hope Ben can wait. I'd like to hear what you have to say. Let me just say this, that in the weekly chart, because I was looking at the daily chart, the weekly chart has an incredible amount of work to do to be able to break above the 30,661 level. But right now, I can make a case that there's a sideways trading range between 13,100 or so and 12,000, say, 500, 400. So, yes, 1 minute. Here we go.
Yes. I bring back to you and your listeners something Larry Pesavento had shared back in September. Namely, he had a friend, somebody he's dealt with for years, in Britain. A Briton who does geometric calculations that come up with time and price targets.
Yes.
Interestingly, for way back and earlier in 2012, according to Larry, this fellow was targeting October 5th for a top for the stock market this year.
Wow, good.
And an S&P target of 1450. Well, the S&P on October 5th, I think, got to
74.
Got to 1464 that particular day. And actually, it was the Dow that physically topped that very day, October 5th.
Right.
And we've headed lower. To add to that, the same analyst, according to Larry, is forecasting 1140 as a target on the S&P before this decline phase runs its course. And, of course, that's, we're 1380, 1390 right now. So
that's 2,000 Dow points, yeah.
Let me lastly add the kicker. I scrutinize current price action versus what I see having gone out previously. I share with you this observation. Back in 2007, when the Dow made its all-time high, was it 2007? Yes, 2007. Yep. It made it October 11th, 2007. The Dow, off that peak, on October 11th, declined for 31 trading days before making a low, then bounced for 10 trading days to make a secondary high, and then proceeded to head lower, going to new lows in 2008. What I will tell you here, quite fascinating, the Dow made its high October 5th.
Hello? Uh-oh, fading. I think we lost him. Oh, we lost him. Oh, I'm sorry, John. That was going to be very, very interesting. And, John, I'm going to go to Ben right now. And if we have a moment before the show, if you want to call in, otherwise I'll be back tomorrow, but we'd like to hear that. So thank you for calling, and we're going to go straight to Ben in Tallahassee, Florida. Hi, Ben. How are you?
Great, Basil. How you doing?
I'm doing well, thank you.
Excellent. Hey, could you please confirm, I'm looking to, I think this possibly could be a great entry point for symbol ROK.
Rockwell Automation.
And looks to me like it's a peak B weekly.
In the
peak
weekly.
A daily.
So this is what I've got. Now, I remember working on this. It's a very interesting one. It's a little complex. I don't know if you can, are you able to see the chart now? You're looking at Tiger TV?
I'm not. I unfortunately no.
Okay. I'm going to do two things. One is I'm going to discuss it, but the other is send me an email, and I will send you the chart back, because this is a very interesting one. In the ChapmanWave, it made a low on the 12th of July at 61.20. It then went to peak A, higher peak A, B, C, D at 69.22 on the 30th of July, pulled back to the 9-period moving average. It went again, peak A, B, C, D. To 73.98 on the 17th of August. Then it pulled back to trough F and started a brand new peak A, B, C. That trough F was at 68.18 on the 26th of September. So I'm not sure. I think you concluded that I went peak A on the 1st of October, peak B, higher peak B is at 72 round number on the 5th of October, hits the 200-period moving average, pulls back, sneaks over it, and goes to 72.84 on the 18th of October, pulls back, makes a cup formation, then powers to what you've called leg A, but it's actually leg D at 79.56. So there are 1, 2, 3 peak Ds in this. Folks, if you want to learn about these peaks in the ChapmanWave, peak A, peak B, C, D, and see how powerful they are, you've seen it not hundreds but thousands of times here at TFNN and in my shows. This is just a great example of it. So I've got peak D, and now it's making the cup formation that says that the recent high of 79.58 could well be tested. At that point, it's going to be either a double top, or it's going to make continue the high-level consolidation by holding on a pullback the 75.71 area of the 14th, and then all of a sudden, you've got leg C if it starts to rally. In fact, if it goes to 79.57, that's leg C in the weekly chart. So do you have a position?
No, I thought given the quality of the weekly, this could be a good entry point. I agree with you, because the monthly is breaking out of an asymmetric. No, it's a symmetric triangle. Not one of my favorite patterns. The only reason is because once you identify it, it's almost at the next left side high, which is at 84.71. This is what I'm going to recommend to you. I think, at least for the short term, right now, there's a bias to the upside. I think if you took a small position, your risk is a close below 75, let's call it 75.50. So that's about a 2.5 point on a small position. I don't think that's a big risk. But the benefit here is that if it takes out, it's at 77.98. If it takes out 78.96, all of a sudden you're looking at that left. I'd like to talk about this chart formation. So do you mind holding on? Do you have time? I'm going to have to go, but I'd love to listen to it.
Okay.
Tonight. Okay, thanks, Basil.
I will continue, and you can listen to it in the archive.
Thank you very
right back.
much, and have a great Thanksgiving.
You have a great Thanksgiving.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. Basil Chapman, Tiger Technicians Hour. And, okay, so just this is to continue with Ben from Tallahassee looking at Rockwell Automation. It's had a fabulous run. The monthly chart, this particular monthly chart says to me there's a good chance, now that I've had a little time to look at it, that it's going to still form an M formation. The dreaded H, the lowercase h, was successful, didn't even get close to the low in the 40s. In the high 50s, it's bounced. And I suspect that it's going to retest, and it's already been rallying while the market was tanking. From the 24th of October, it went from 68.30 all the way to the recent high of 79.56. I like it. I think that nibbling here would be a great idea for one. And all you need to do is to put your stop in. I'd have a trading stop and a small position only. Why? If it takes out 79.56 and the general market starts to rally nicely, this should go with the market, number one. Number two, the monthly chart technicals are improving a lot, but both the daily and the weekly are not at 80% yet. So I think it has the strength to get there. If it does have the strength to get there, then there'll be legs C the moment it breaks above 79, what did I say, 47? 79.57. So I like it, but only a small term trade, a small position, and you've got to have a stop. I probably would have it less than that, but 76, 77. But actually, to really play it fair here, you need to stop somewhere around 75, 67. Why? Because at 78, where it is now, since we're talking it's going a little higher, it's a 2-point gain if it breaks above the previous high. But my suspicion is that once the weekly breaks above 79.56, then the left side next resistance will be up at the 80.17 level. So you've got yourself a much better risk reward once it picks up to the upside. And then use a trading stop. And then if it does break above the previous high of 79.56, your entry should not take a loss. If it's a small position, Don't take a loss. So, okay, I did that. Now, so Zita, John, who had called me, he's in the den. He's posted the whole thing, and it's very interesting. Hope he has a chance tomorrow to talk about it. Now, let me just do this. I'm going to do this on the daily chart, because in my webinar that comes up on November the 6th and 7th, the timing for that, December the 6th and 7th, is going to be really important. Why? Because I think we can have a lot of clarification whether the Dow has been able to get to the 12,000, over the 12,990s, just exactly what's going on here. There's still a lot of bearishness, but at the same time, there's too much bullishness as far as I can see in terms of the people who still have been bulls and remain bulls. So what I'm looking at here in the Dow, I'll make it real simple. At this particular point, the candle that we're looking at, potential candle for the day, is actually a very interesting candle because it's starting to match the kind of breakout patterns that are very quick from downside to upside in the V formation. That says if the stochastic, which is at 19.82, the slow stochastic, is able to break into the 21, maybe 22 level by tomorrow afternoon, that says that the 200 period exponential moving average at 12,903 should be a target. Conversely, if there's just sudden really bad news, and the bad news gets the Dow down and it holds lower than the low of today, and I said to subscribers, watch the 12,750 to 12,020 area, because that should be the containment area. Today the low is 12,729. That's going to be key for me. So if it breaks under that, then I'm looking at the candle of yesterday, a big chunk of it possibly being taken out to the downside. At this particular point, I just have to think that the bias remains to the upside because of the way that it moved up and because of the short-term sustaining power based on the volatility index, which is still very low. It's at 1511. So we've got that movement that I expected, the pullback based on the ChapmanWave trend gauge, and now we're seeing the counter trend bounce, and we'll see the bounce away from the pullback.